Recently, Jim Rickards talked about a potential global liquidity crisis that could really hurt our financial system. He pointed out some key reasons why this might happen. Basically, Jim is saying that if these factors aren't managed well, we could be in for some serious trouble financially. Before we dive in, if you've ever thought about investing, the first link in the description takes you to Interactive Brokers, the platform I use. Introduction to the Global Liquidity Crisis. Think of a global liquidity crisis like a town running out of water. When there's plenty of water, everyone can wash their cars, plants thrive, and businesses can keep going. But if there's a sudden shortage of water, everything starts to sputter. People can't wash their cars, plants start to wilt, and businesses that rely on that water may even close down. In financial terms, liquidity means having enough cash or easily accessible assets. So, during a liquidity crisis, there's just not enough cash flowing around in the economy. This isn't just a regular financial problem or recession. It's a serious situation where businesses find it hard to get loans or funding, and that can lead to many companies struggling or even failing. Understanding dollar shortages. A dollar shortage occurs when the demand for US dollars exceeds the available supply in the global market. This situation can arise from various factors, including geopolitical tensions, changes in trade balances, or shifts in investor sentiment. As the world's primary reserve currency, the dollar's availability is vital for international transactions, trade, and investment. When dollar shortages happen, countries and institutions may struggle to meet their obligations, leading to increased borrowing costs and financial instability. The ripple effects can be felt worldwide as businesses reliant on dollar-denominated transactions face challenges in securing the necessary funds. The role of the Federal Reserve in money printing. The Federal Reserve plays a pivotal role in the U.S. economy by controlling the money supply through various monetary policy tools. One of the most significant methods is through open market operations, where the Fed buys and sells government securities to influence liquidity and interest rates. While the Fed has injected trillions into the economy, much of this money has not circulated into the broader financial system. Instead, it remains on the balance sheets of banks as excess reserves. This phenomenon creates a disconnect between the amount of money printed and the actual liquidity available for lending and spending in the real economy. Monetary policy versus fiscal policy. Monetary policy refers to the actions taken by a central bank to control the money supply and interest rates, while fiscal policy involves government spending and tax policies. Fiscal policy has become important due to government spending aimed at stimulating the economy, contrasting with the indirect effects of monetary policy, the international monetary system, and euro dollars. The international monetary system is a complex network of institutions and currencies that facilitates global trade and investment. Eurodollars, dollars deposited in banks outside the United States, play a crucial role in this system. They allow for the expansion of dollar liquidity beyond U.S. borders, enabling international transactions without relying solely on the domestic money supply. However, as the demand for eurodollars increases, the dynamics of the dollar shortage evolve. Banks and financial institutions must navigate this intricate landscape to secure the necessary liquidity for their operations, often leading to increased volatility and risk in the financial markets. Collateral and its importance in financial transactions. Collateral serves as a guarantee for lenders in financial transactions. It reduces the risk associated with lending by providing a safety net in case of default. In a world where leverage is common, the quality and availability of collateral become paramount. Financial institutions rely heavily on collateral to back various transactions, including loans, derivatives, and other financial instruments. The ability to pledge quality collateral can determine the terms of financing and the overall stability of the financial system. Given these factors, a thoughtful approach to investing is crucial. I found the Interactive Brokers platform to be a valuable resource. You can find it linked below. Go ahead and check it out. The scarcity of quality collateral. Right now, there's a big worry in the financial world because there aren't enough good assets to back up loans. Banks are getting pickier about what they accept as collateral, which has made high quality assets like US Treasury securities more in demand. This scarcity leads to higher costs for borrowers and can exacerbate liquidity issues within the financial system. Institutions scramble to obtain the necessary collateral to meet regulatory requirements and secure funding, driving up competition and prices for these assets. The mechanics behind the strong dollar. The strength of the US dollar is often seen as a paradox in the context of a struggling economy. The dollar maintains its value due to a complex interplay of factors, primarily driven by global demand for dollar-denominated assets. When uncertainties arise in global markets, investors flock to the safety of the dollar, pushing its value higher. One significant element is the role of eurodollars, which are dollars held in banks outside the United States. Eurodollars facilitate international trade and finance, allowing banks to lend and borrow in dollars. This dynamic creates a continuous demand for dollars regardless of domestic economic conditions, potential bank failures, and historical comparisons. The current financial environment raises concerns about the stability of banks, reminiscent of the 2008 financial crisis. The potential for bank failures is exacerbated by the liquidity crisis and the increasing difficulty in obtaining quality collateral. If a major player fails to meet a collateral call, it could trigger a domino effect, leading to widespread banking instability. Financial crises typically arise from excessive risk-taking and lost confidence. The 2008 crisis highlighted this, and today's lack of quality collateral may similarly undermine trust, increasing contagion risks among banks. Supply chain issues and their impact on inflation. Supply chain disruptions have become a significant driver of inflation in recent years. Factors such as transportation bottlenecks, labor shortages, and rising energy costs contribute to increased prices across various sectors. When goods cannot move efficiently, shortages ensue, leading to higher prices for consumers. The current inflationary environment reflects a combination of increased demand and constrained supply. As businesses struggle to obtain necessary materials, they pass costs on to consumers, creating a cycle of rising prices. The psychological aspects of demand pull inflation. Demand pull inflation often stems from consumer behavior and expectations. When consumers anticipate rising prices, they tend to accelerate their purchasing decisions. This phenomenon can create a self-fulfilling prophecy where increased demand leads to higher prices, validating consumer beliefs. Throughout history, such psychological factors have played a crucial role in shaping economic conditions. For instance, during the 1970s, consumers rushed to buy goods in anticipation of price increases, further driving inflation. Policymakers must grasp psychological factors, as consumer sentiment can complicate monetary policy and fuel ongoing demand pull inflation. The Fed's role in controlling inflation. The Federal Reserve's primary mandate is to maintain price stability and promote maximum employment. In the context of rising inflation, the Fed faces a challenging task. While it can raise interest rates to curb demand, such actions may also lead to a slowdown in economic growth. Historically, the Fed has employed various strategies to manage inflation, including adjusting the federal funds rate and utilizing open market operations. However, the effectiveness of these measures is often debated, particularly in the face of supply-side constraints. As the Fed navigates this complex landscape, it must balance the risks of inflation against the potential for economic recession. The political nature of Federal Reserve decisions. Fed operates within a political context that influences its decision-making process. While the Fed is designed to be independent, its actions are often scrutinized by lawmakers and the public. Political pressures may lead the Fed to prioritize short-term goals over long-term stability. Ultimately, the interplay between politics and monetary policy underscores the complexity of the Federal Reserve's role in the economy. As it grapples with the current economic challenges, the Fed must navigate these political dynamics to achieve its dual mandate,